Watson from Mike Watson Investing. Excited to share with you a fantastic presentation today. Little presentation on capitalization rates. I get a lot of questions as I travel and do real estate investing, deal with my investors and students on what a capitalization rate is, how it works. So we thought we'd put together a little presentation for you here to take a peek at it. So follow along with me. You may want to grab a pen and paper to take some notes, and we'll get this going here. If you're a member of our Facebook group on Facebook, which is Mike Watson's Highest and Best Use Facebook group, our real estate investing Facebook group, you can post a question here, and I'd be more than happy to send you a copy of the slide deck here too, if you'd like a copy for your personal records. So capitalization rate, basically by definition, is oftentimes referred to as a cap rate, and it's simply the ratio of the net operating income to the property asset value. And we'll go through some examples and some things here to get you versed on this so that you're an expert on cap rates when we're done here in just a minute. Now, we use the cap rates for a couple of reasons. The first one is for proper value or the proper valuation of an income-producing asset, giving the current market conditions. The next thing we want to do is determine value changes in assets where we change either the income or change the expenses. Now, both of those are going to affect the NOI and therefore affect the capitalization rate, the NOI, again, being the net operating income. So here's the formula that we use on the capitalization rate. It's simply the capitalization rate equals the net operating income divided by the sales price or market value. Now, you might wonder why there's two there. If someone's listing a property for sale, you use the sales price. Someone has an apartment complex and they want to determine what it's worth, you can use that, and that would be your market value if it's not currently listed. Or if you want to determine, gosh, what's the value of my own assets? If you own some assets or some clients have some, this is great to determine the value of a property that is not currently listed. So your cap rate, your CR, will equal your NOI divided by your sales price or MV market value. So how do you find a cap rate? I get asked this a lot because some people can intuitively understand how to use the formula if they know what the rate is. So one of the things that we'll do, if you go into a new market or you've never used this before, what you want to do is find the sales. You want to go to the sales to get the answer, and we'll simply use the capitalization rate formula in markets to determine what the prevailing cap rate is. So we'll recommend that you get access to the MLS. If you're not on the MLS, contact an agent or look on some of the other places where lots of apartment complexes are listed and sold. Some of the public domains and sites and different things. That way you can find quite a few of those. You'll find the most recent sales, and you want to get as many of those as possible and then use the following formula. So you'll take the NOI, which again is our net operating income. You'll divide by the sales price, and that'll equal a cap rate. Now, one of the problems investors run into is, say you pulled up an MLS listing of the last 20 plexes that have sold in your marketplace. What you'll do is you'll take, oftentimes the full expenses are not listed. So we have a formula for that too, just a kind of a representation. To get that NOI, you'll take the rents. So we'll take, say they have 20 units, and we'll do an example, an actual example here in a minute. Take the rents times the number of units times the number of months times 0.7. Now the 0.7 there represents we're subtracting 30% in expenses. And that's kind of a standard rate. We'll get into that more in a little bit here, but that'll give you your NOI or net operating income. So again, you take your gross rents monthly times the number of units times 12 months in a year. We'll subtract out the expenses by timesing by a 0.7, factoring roughly a 30% expense. And then you'll take that NOI, like we referred to before, and simply divide that by the sales price. And that'll give you the cap rate. You want to get as many buildings as you can, and you'll start seeing a trend appear. Now, if you're in a market where you don't have a whole bunch of the same types of buildings that have sold, you can certainly do different sizes. So if you want to buy a 20-plex, you can take the 20-plex and use comps there, but you could also go, gosh, 6 plexes all the way up to 40 plexes, and you'll see trends. Now, the numbers that you'll give the most credence to will be the units that are closest in size and location and different things like that. But what we're trying to do here is just kind of get as many of these cap rates figured out, and you'll see exactly what the numbers are looking like. Now let's use a cap rate example. Let's suppose that we ran across a 20-unit apartment complex. Gross monthly rents in each of the units are $900 each. Expenses are a standard 30%. Again, we'll generally take 30% in the absence of perfect expense numbers. Even on buildings where I've purchased before or talked to before, and the seller says they have accurate expenses, I've often found sellers don't know how to calculate those very well. They don't account for those very well. Some of them might be a little deceptive in the numbers they disclose to you. So whatever numbers they give me, if it's below 30%, then I'll use 30%. If it's above 30%, then I'll use the number that they have. So you want to make sure that you're kind of giving yourself a little bit of a leeway there on accurate expenses. Now, let's say that this 20-unit apartment complex at $900 a piece per unit per month is going to be for sale for $2 million. So what is our cap rate? And this is how simple this gets, guys. Remember, again, the gross operating income are all received income before expenses. So we'll take 20 units, that's 20 apartments, times $900 each a month, times 12 months. Our expected gross operating income is going to be $216,000. That'll be our gross operating income. And again, we don't want the gross, we want the net, but we got to start with the gross to get the net. And the GOI comes again before vacancy, advertising, insurances, taxes, property management, repairs, lawn care, all kinds of expenses like that. So you want to factor that. Now, taking these numbers to our next slide here, again, normally we remove actual expenses from the GOI, but as I mentioned, sometimes those aren't usable, and you want to take the worst case scenario on expenses. So, but in the absence of perfect numbers, again, we'll use a rough 30%. Now, if you find a building, you want to buy it and you use 30%, that doesn't mean you don't do your due diligence and find the actual expenses and compare that. So you want a pretty comprehensive list there. So if we take that $216,000 in gross operating income from the prior slide times 70%, again, factoring the 30% expenses, our net operating income will be $151,200. And again, that's the net operating income, or NOI. That would mean if our net NOI is $151,200 and we divide that by 2 million, the capitalization rate on this building would be a whopping 7.56%. Now, I say whopping in that case because traditionally 7.5% is a pretty good market if you're not in a cash flow market like the Midwest or some of the other places that have higher rates of returns. But this would be a building that we would try to purchase immediately in most markets across the country, because most markets are prevailing cap rates right now are typically 5.5% to 6% right now. So if you find a property with a higher cap rate, what that means is you're getting a higher rate of return based on the current sales price. So let's take a look at that and kind of see how we can fluctuate these numbers a little bit and how we might take that for a spin. So in this case, if we bought this building for $2 million and the market cap rate was 5%, what could we potentially sell the building for? So gosh, what that would mean again here is, let's look here. If we're buying it at 7.56% and the market rate is a low 5%, which some markets do have that, what could we potentially sell the building for? What I'm also saying here is, if you can buy properties with great rates of return and you're in a market that has a lower rate of return, you can lower the rate of return and raise the sales price and make a profit. We call that a cap rate fixer-upper. We'll get that to here in just a second. But again, if you take that NOI divided by the capitalization rate equal the sales price, you can say this building of $151,200 net operating income, if we wanted to sell it at a 5% cap rate, that building would be worth $3 million. So it jumped to $3,024,000. Amazing jump in value there, having done nothing to the building, but simply changing the cap rate. Now, this is a lower rate than my personal market right now. 5% is on the outside edge. We do 5% in some markets right now, in some places here, when buildings are brand new, for example, or there's some other extenuating circumstance. But this is a lower rate than we might achieve in the market. But look at the value jump. In fact, so what I wanted to do is show you the value jumps and changes as we change the capitalization rate. So what is the change in a cap rate due to the value on this very building with this example? So again, factoring that 20-plex at $900 a month times 12 months times a 0.7, so we subtract out 30% for expenses, we get an NOI at $151,200. Now, the cool thing about these numbers just stacked back to back to back to back here is if you take that NOI and divide them simply by a different capitalization rate, look at the value changes. So if I buy that building for $2 million and I get it at a 7.56 cap, If I turn around and sell that, if you look at the top line there for a 5% cap, what that means is there's enough pressure in the market that I can sell it for a lower rate of return, and investors will still be interested in purchasing that. But at 5%, that net operating income gives us $3,024,000. And as we raise those rents at 151.2 divided by 5.5%, 0.055, this is getting more into the range of where most markets are. You're still a whopping $2,749,090, which is almost $750,000 more than we paid for the building. The next one, number 3, at 6%, we're still coming in a value, same net operating income, same building, same everything, at $2,520,000. If we were to sell this building at 6.5%, that building's worth $2,326,153. At 7%, gosh, it's still worth $160,000 more than we paid for that building. So there is value in seeking buildings out, finding those that are not for sale, talking to owners that have great rates of returns. Because traditionally, if owners have owned their buildings for a while, they'll consider higher rates because that's traditionally what they remember. Most investors that have been around for a minute know that the rates are very low traditionally, considering what past rates have been. So oftentimes they'll come on the market, not realize what the new low rate is, and sell their building, and you can be there to profit from that. But even if you go to a 7.5% cap, it's still more than the $2 million that we're going to pay for this purchase price. So fantastic little exercise there in seeing if you offer a lower rate of return up to a higher rate of return, what it does to your sales price. So every good seller is going to want to sell at a low cap rate, and every good buyer is going to want to buy at a high cap rate. And then you can kind of fluctuate in between. So the question I asked then is, what is this building really worth? Now, remember a minute ago, we discussed how you determine a cap rate in a market. So if you wanted to know what this building's really worth, you'd get similar buildings, get the gross rents, determine the gross operating income, subtract out that 30% expense ratio, and divide by what they've sold for, and that will give you the number and where you fall here in the list. Now, the good news is gosh, if I found that building at 7.5%, 7.56%, I'm going to make a profit on that deal right there. That's a good deal. So what is the value of net income? I wanted to do this real quickly because I'll tell you, if you guys learn the value of income, you'll become very strong when it comes to increasing income, finding buildings, for example, that have been owned for a while and have low rents, or improving your units to the point that you can increase rents, or decreasing expenses. There's some very cool things we can do there. And again, let's assume we're in a marketplace where 6% is the prevailing cap. Let's just show you exactly what some income is worth. So what is the value of, let's say I have a building, we can say it's a 20%, a 20plex, doesn't have to be the same building, but it can be. If I go in there and I raise rents simply $50 a month per unit, and then I find a way to save $20 per month per unit, which, guys, these aren't big numbers. These aren't big stretches or big changes. So what I'm going to do is have a net $70 increase in my net operating income monthly. What does that do to the value of my building? So I'll tell you, having property managed thousands of doors over the years with many managers or many owners, you want to make sure that you understand exactly what you can do to manipulate and improve values, equity positions, cash flows, because property management is simply the most lucrative business in the world if you understand more than just a simple day-to-day management with tenants and property. So some great stuff there, but let's take a look at this. So if I took my rents from $900 a month, again, supposing we're in that same building, let's go back to that same building, and I simply raise the rents to $950. Let's look at our income increase. So we go $950 times 20 units times 12 months. That changes our GOI to $228,000. Now remember, we still have to subtract out the expenses. So we're going to take $228,000 on that next line there and times by 70%. Again, factoring a 30% expense reduction. That gives us our NOI of $159,600. But again, let's not forget, if we're saving an additional $20 per month per unit, that's a savings annually of $20 times 20 units times 12 months. That's an additional $4,800 in additional expense savings. So I've got to take my net operating income and add back those expense savings. This will give me a whopping $164,400 net operating income. Now, if you remember, our prior net operating income was $151,200. So this is a pretty handsome increase in $13,200 to the net operating bottom line. So what does that do to the value change at 6% if I'm in a 6% market? Well, gosh, with the old NOI, I've got the N900 a month in rents times 20 units times 12 times 0.7 to subtract expenses gives me the 151.2 versus our new NOI with our increased income and decreased expenses. So that, again, that 164.4 represents an annual increase of 13,200. Now look at the value jump here. I want you to focus on a couple of things. If I take 151.2 and divide by 6%, so I'm in a 6% market, there's what my building's worth. Now, having changed the rents by $50 a month and lowering expenses by $50 a month per unit over a year, my net income is going to jump up 13,200. The commensurate and return value in my purchase value of my building, my sales value at 6%, that same 6% is going to be $2,740,000. So I can literally pick up $220,000 right there in equity or additional profit. So man, gosh, and we're not talking about a big number there, guys. $50 a month in rents and $20 a month in net expenses decreases. That's almost $250,000 in equity or additional profit on a simple 20-plex. So imagine if you had 100 units or a portfolio of a larger size. One of the things that we do is we constantly looking for ways for increasing income and decreasing expenses. So makes me ask the question here, what is the value to a building annually if we even raise $100 per month in rent increases for the NOI? So if we can affect the bottom line NOI by $100 per month per unit, what's the value change? And again, we saw one that was pretty close to that $70. But if we have 100 times 20 times 12 times 0.7 will equal a $16,800 increase in net operating income divided by the 0.06. If we do those numbers right there, that'll change the value of our building by a whopping $280,000. So think about that for a second. Value increases as income increases. One of the favorite sayings I have is you change the rents, you change the value, change the expenses, change the value, change the net operating income, change the value. Now, this will give you some benefits here. Value plays with this strategy and this understanding that you have now might include, number one, the cap rate fixer-uppers. Number two, the income fixer-uppers. Number three, property management fixer-uppers. Let's go through some of these. So again, a cap rate fixer-uppers, when I buy something with a high cap and lower it down to market rates, if I lower it to a market cap, it'll raise the value. Number two, the income fixer-uppers. If we take a building and simply change the income, we change the value. That's an income fixer-upper. Property management fixer-uppers, one of the things good property management companies do is they'll look at your net operating income annually with your buildings. They'll adjust those, producing income, profits, additional cash flows after all expenses, and happy clients, which will do a lot of other things, again, that make property management the most lucrative business in the world. Number four, expense fixer-uppers. We've bought buildings before and simply and dramatically reduce expenses. Someone's at the top rate for rents, but we dramatically reduce expenses. And this has a huge value increase for the building if we can, this is kind of understandable here, but every dollar of expense that we remove is the same value to the bottom line of a building of every dollar of income that we add. So whether you're adding income or subtracting expenses, it has the same net result to the future value. Number five, we have physical income fixer-uppers. Now, this is something I want to share real quickly. We buy buildings all the time to find reasons to add income or to subtract expenses. For example, we might buy a 100-plex in a market and add 30 covered stalls. And for people that want to add 30 covered stalls, we'll say to the 100 apartments, hey, who wants to rent a covered stall? So we'll charge an extra $50 or $100 a month for the covered stall. If we have 30 stalls times $100 a month, that significantly alters the value of that building based on new income. We rent utilities, appliances, do all kinds of fun things that way. And you can see changing net income is a very prosperous business to get involved in. But this will give you a very quick and overriding understanding of capitalization rates moving forward. Now, this is Jesse. You better get busy. I want to talk real quickly about some of the upcoming events that we have. Great stuff for you to get involved. First event I want to share with you, and if you're watching this video after these dates have passed, gosh, get on our Facebook group. Mike Watson's highest and best use, REI. Get involved there. There's an event section, and you can look at the upcoming events we've got coming. Here's the ones that we have coming currently. Our drip day. Guys, one of the things I'm doing is I'm teaching my students how to find properties like the one we just mentioned. We're going to have a meeting on March 17th, 2018 here from, this will be from 9 a.m. to 2 p.m. or whenever I finish. Sometimes I do get a little winded, but whenever I finish, we're going to be at the Staybridge Suites in Midvale, Utah. This is going to be one of our smaller classes where guests are welcome. We're going to charge $30 for this. So I'm going to produce 12 different letters that you can mail out to the list that we're going to be producing. You'll get a hard copy of the letters. We'll send you an electronic copy as well. But $30 is the number for you to attend. We'd love you to have some guests. And it's going to be a fantastic day on how to find properties using drip systems with databases and mailing lists that we create. Next event there is the granddaddy of them all. This is the holy grail of real estate investing, seller finance degree camp. I've got a camp coming up on March 22nd to the 24th. This is a 3-day event. This will be at the Staybridge Suites in Midvale, Utah. And again, this is a 3-day paid event for only the best of the best of the best of our students. So all students must be enrolled to attend, and we've got a great day there. You will leave having participated in the foremost comprehensive and most intensive seller finance training in the world. Never seen anything that even comes close to that, and that's high praise for that class, but it's amazing. So get there for that. If you have any questions on that, again, hop on the Facebook page, Mike Watson's highest and best use real estate investing page. Ask to join if you're not a member, and then you can message us or just simply post on the wall there and we'll get you involved. Build Your Investing Business is our next event on March 29th from 6 to 9 p.m. That'll be at the Hampton Inn in Sandy, Utah. This will be how to become an investing business. Most people don't understand the difference between wanting to be an investor and then actually setting up, operating, and acting as an investing business. This is a free event. I didn't mark this here. So all guests are welcome to this, and you're welcome to attend with guests. You'll want to get enrolled, and we'll show you how to be an investing business. And we've seen some great improvements in people's activities and the way they handle themselves when they consider themselves a business, and we'll go from there. So upcoming events, capitalization rate, guys, happy investing. Have a great day. We'll talk to you soon.